After the end of the Cold War, the world, particularly South and East Asia, saw a rapid reduction in extreme poverty. The misery left behind by brutal communist regimes from China to the Soviet Union had been exposed. And a globalized world with large degrees of economic freedom everywhere seemed inevitable. The fall of the Soviet Union and its satellite regimes also gave way to an expansion of democracy and human rights around the globe. Moreover, there was a widespread belief that China would inevitably turn democratic as market reforms and international trade allowed millions of Chinese to join a rising middle class. Sadly, this turned out to be wishful thinking. The Chinese regime, particularly in recent years under Xi Jinping, has instead deeply solidified its authoritarianism, forcing millions of Uyghurs into concentration camps, crushing freedom in Hong Kong, and building the world's most sophisticated surveillance system. None of this would have been possible without the massive economic power that China's regime has amassed in the last 2 decades. Power that has come aided by the same international finance systems and trade that have made other freer parts of the world wealthier. The human rights abuses committed by the Chinese Communist Party should make the democratic world rethink its commercial ties with China. And some are starting to wake up to this reality. There are glaring exceptions, of course.
Uncertainty. Markets don't like uncertainty. Markets like actually totalitarian governments where you have a understanding of what's out there.
But the biggest world players are still happy to deal with the CCP. BlackRock, the largest asset manager in the world, recently launched a major initiative in China and has long been recommending U.S. investors to invest in the country. The problem runs deeper than just one firm, though. When it comes to international stocks, China is classified as an emerging market. Given that most of the emerging market indexes are capitalization weighted, and since China is such a large economy, these indexes tend to allocate up to 40% of their weight to China. In practice, this means that when you invest in an emerging market fund, you are much more likely to be offered products that allocate a significant part of your investment to China. But China is not the only dictatorship that benefits from access to international markets. Many other brutal dictatorships like Saudi Arabia, Egypt, and Russia are also considered emerging markets, and stocks and bonds from these countries are naturally offered under many indexes. It is time for the democratic world to demand accountability from companies and investment firms that do business in dictatorships without any concern for the human rights records of these regimes and the risks their investments pose to fueling egregious abuses. This is why HRF has launched the Responsible Finance Program, aimed at raising awareness of the dangers of investing in countries ruled by authoritarian regimes and how we can ensure that international trade and investment can be a force for good. As part of these efforts, and to raise awareness of the issues we highlighted in this video, we have launched the Defund Dictators tool in collaboration with Life and Liberty Indexes. At defunddictators.org, you can look up any U.S.-listed emerging market exchange-traded fund to see how much of it's being allocated to countries ruled by authoritarian regimes.